Looking at this market, it's up about 45% this year. Are there any areas where this market is possibly out of kilter with reality and fundamentals at all? Do you get a sense that it's getting very difficult to kind of value businesses in the current upswing that we've seen?
Well, the market has recovered. This year has been a better year compared to last year, where most stock prices have really edged upwards, double-digit growth, mainly because investors have seen value in the counters, and most investors use earnings multiple as their yardstick for measuring stock value. So most stocks have been trading at very low PEs, and this has attracted investors.
Attracted investors into players like East African Breweries. It's sitting at around about 225 shillings. An all-time closing high has been hit, but it's struggling now to continue with that momentum, where foreign investors in particular have been in hot pursuit of the stock. Are you chasing that counter at these current levels?
Well, East African Breweries has been attracting a lot of attention, especially from foreigners, for the simple reason that one, it has a strong management, and Diageo has been ensuring that it's run smoothly. But at the same time, it's a mature company which has been able to weather economic shocks and maintain its profitability, those at times minimal margins, but has maintained its profitability. But something else that attracted investor attention is the acquisition of the breweries in Tanzania, for which now EABL is trying to diversify their portfolio, not only Kenyan but also regional.
Just how much more room do you see the share price having to run, given the fact that there is some fundamental basis for the kind of rally we've seen on the share price so far?
Well, it is, in this quarter, I think it is sort of hitting its resistance levels, but at the same time, we don't expect much decline, for the simple reason that most of the shareholders are institutional investors who are long-term investors. So you find that going forward, there'll be very minimal retail activity, and retailers are the ones who more often than not trade their shares frequently. So we'll say there's a downside impact on free float.
While there's limited room for this counter to run any further for this year, let's look at a player like Safaricom, because it seems to be sitting on the opposite end of this spectrum. It's been amongst the most active shares at the NSE. It's sitting at about 4 shillings 55 on a trailing PE of 11.84, and still being maintained by many analysts across the board is that this price is looking oversold. What are you making of current valuations on Safaricom?
Well, at multiples of 11, that's a very attractive counter, for which I'd also advise investors to get in. What we are seeing in Safaricom is a situation where there's a shift from, like I said, retail investors to long-term institutional funds, who then pick up the stock, and mainly foreign activity, who are seeing value in the counter. While locally there's a lot of industry rivalry, but most investors are seeing the type of strategies that Safaricom is employing in order to safeguard its bottom line by diversifying its revenue streams. So at 11, definitely Safaricom is still a buy. The only thing beating maintaining its low price is because of the high free float that is a characteristic of Safaricom.
Let's take a look at a player like Access Kenya, sitting at 15 shillings thereabouts. It's a new month, a new 12-month low for that counter. Should investors be using this low point as an entry point into this counter? Because while it may be low, there's a very big cloud hanging over Access Kenya, and that in the form of competition from telecom players like Safaricom that are actively engaging within the data space more aggressively.
Well, yes, true, there's a lot of competition, and what is failing Access Kenya is that the market hasn't seen it coming out clearly in terms of strategies to be able to beat that competition, to be able to increase its revenue streams. At the same time, Access had suffered a period of boardroom wars where directors were being replaced left, right, and center. So there's a little bit of anxiety amongst investors. So probably investors are in a wait-and-see mode to see what will actually come out of Access in terms of their strategy going forward.